I mean, I agree with Johnny. You've got to watch the US because the US investors see themselves as 2 or 3 years ahead of Europe, and they're probably in certain cases even further ahead. And what we're seeing, well, we're focusing on raising capital for what I would call quick in and out strategies. So getting your money back before the potential of a downturn gets even higher. So the US is nervous. A lot of the state plans, the insurers, etc., over there are getting a lot more selective. But they're also looking at, there are 2 things on our list when we look at clients and whether we should take on mandates. Their track record is critical, it always has been, but their deployment capability and their ability to choose the right deal is fundamental now, because if you get it wrong now, you're going to walk into the same mess that we had for 5 years after 2007.
Okay, interesting.
The big difference between the two is debt.
Debt, yeah. Okay.
Debt is the difference. Then in 2007, debt was driving and fueling the market. Today, it's still other people's money.
Also, in 2007, there was sort of a negative return on property. We're still a positive yield gap at the moment of 200 or 300 basis points as a consequence of QE.
I agree with some of that. No, I agree with the yield gap. The bit I worry about is is debt. Debt, I agree, debt's lower, and that was one of the major issues. We spent 5 years at Global Investors sorting out the mess of some of the funds that maybe we inherited through a merger, but that had been over-leveraged and bought the wrong assets. I think there's less buying of the wrong assets so far. There's a lot more, there's a lot less misalignment in the market that drove some of that. So there were some big managers out there in 2007 where some of their staff were being paid huge bonuses just for buying, not for performing, just for buying. I think that's gone, and investors are very careful and very wary about misalignment in managers. So, but the bit that worries me is the shadow banking industry. A lot of equity has been raised for debt funds, and not all of it can get into the market, and that's the bit that I worry about pushing.
Although, quite a lot of those purchasers have sort of constitutional constraints on the level of gearing, and to the extent to which cash on cash, sort of positive cash on cash return is part of the underlying appraisal.
Yeah.
They don't necessarily want to gear right up to the hilt, I think, in a sense, some ways, unless it's like a development situation where
so there's debt, there's the positive yield gap, and there's more discipline, I would say, and also more regulation, of course. We're working in a regulated business, which is, it's gone up substantially since the last downturn. But there's also quite a few parallels, aren't there? There's the flight to quality and to core because of the risk which Thomas has outlined, you said yields won't compress much further. I think they will compress much further. Look at recent deals in London. If you have a long lease, UK 25-year government bond is at 2.7 or 2.8%. There's still some compression potential there if you have a long secure tenant these days.
And the one to look at this year was logistics, because if you look at logistic yields, you mentioned that, Thomas. I think that we've seen yields in core office come in core markets in London, down into the mid threes. The UK logistics market's always been 100 points ahead, 75, 100 points ahead of the continental market. Today that gap is probably 25 points. It's probably late 4s, early 5s in the UK and early 5s in Germany. And from there emanates the sort of yield gap around Europe. But that's come in very strongly as investors have gone towards that sector.
Is that sort of scope for more compression partly a consequence of sort of relative values and the impact of QE? So you're therefore that sort of is subject to the uncertainty and volatility about how the fixed income market will perform when interest rates go up, and sort of reversion to mean, etc.
We live in an era of artificially compressed interest rates. It's artificial, isn't it?
Yeah.
And therefore, this is a real distortion to the market. Yeah. And that's why everybody's afraid of interest rate rises. The day this distortion goes away, or is distorting the other direction, we'll have. We're again Union Investment. We run open-ended real estate funds, and open-ended means just money coming in, there's also money being redeemed. So therefore, it's something which we watch very carefully.
Although we do find some of our sort of institutional clients say that if interest rates go up on one level, the net present value of their liabilities go down, and it's all about matching assets and liabilities. So within certain parameters, they're less concerned about it.